right, good afternoon, everybody. Welcome to the September 19th edition of News from the Front Lines of Business by D.W. Huff Consulting. I'm David Huff, CPA, PFS founder here. And made it another week and decent amount going on. Last week was a tax deadline, so everybody, I'm sure, we were definitely very much preoccupied with that. But now things are getting a little bit more normal. During the course of the week, you may have noticed there are a couple things going on: a Fed rate cut, and a couple other things that have come up in discussions with clients, as well as this third item here, this tax credit deadlines that we need to be aware of. As the end of 2025 is upon us. But so going back to the rate cut, so probably saw a good bit of news about that. It got some coverage, and I guess the cut comes about. And the Fed, who controls these things, has a couple things that's going on. Number one, they're trying to control inflation as well as the overall economy. So by manipulating this short-term borrowing rate, it can have these kind of ripple effects throughout the whole economy. So this last cut was 0.25%, 25 basis points. So that's good for our short-term stuff. And like I said, it has to do a lot with the weakening economy, jobs growth, and things like that. So it's not only are they trying to keep the labor market afloat, at the same time they're also trying to balance that against inflation. Because if there's too much money and people are doing too well, inflation gets out of control. So it's kind of a complicated scenario that they're trying to manage here. And it's also some talk of more rate cuts in the future, because things that I think. The consensus seems to be that they took a little bit longer than they should have to make this cut, so things are a little bit worse than they would otherwise be. So there's going to be more down the line. So the question that has come up during the course of the week is, what does that really mean for you as an investor? I guess that it's really not a straightforward answer. A lot of times people will say, if I'm going to buy a house, my mortgage is going to go down. That's not necessarily the case, because mortgage rates aren't 100% driven by this short-term rate. Those are driven more by this 10-year bond. It's another type of bond that's issued by the Feds. So that's out there, and that's publicly traded based on other factors in the economy. So it doesn't necessarily mean that your mortgage rate. So this point number two is, so there might be an indirect effect on mortgage rates, but it's not 100% correlated with this rate. However, looking at the first point here, cheaper borrowing costs for some of your short-term things, so your car notes and things like that, credit cards, all that is driven by this short-term rate, and everyday consumers should see a benefit there. All right, but overall, when those things kind of happen, when we're talking about short-term borrowing costs being decreased, there is sometimes some more stimulus to the overall economy, a little more spending happens. So even with a weak job market, the people who do have a job might be spending more money and affecting things positively there. So and there's other things there, investor sentiment, the general attitude of the market seems to be better and more optimistic when more money is flying around. So that's definitely one of the, a couple of the positives from this thing here. But generally, anytime the Fed feels the need to cut rates, that's overall a sign of things not really going as smooth as they would like. So be careful. And I guess another thing too, looking at some of the differences, was looking at some of the terminology, how these things get calculated. They were looking at inflation rate. Currently it's sitting 3-ish%. They like it to be more like 2%, and it seems like that's not going to ever happen. But the things that they look at when calculating inflation is this PCE versus the CPI. So the PCE takes out energy and food costs. So they I guess because those move around more quickly than some of the other things in that basket of goods that they look at when they're determining how much overall prices have increased. They take those things out. It's supposed to be less volatile. So it gets really, we look at all the factors that come into play, how they make these decisions. It's mind-boggling how much they look at. So, but at the end of the day, 25 basis points cut, and it should do you some good on your short-term, credit cards and car loans and things like that. But as far as the long-term goes, we'll see. All right, so also this week, as we're talking to people and looking at, tax return data and gains and losses on, investments in real estate and things like that. Just another lesson on the real estate. So particularly, an issue came up on a commercial real estate side of things. So, had a situation where this particular investor was looking at home sales in the area, and based on the increase in the home sale prices, was of the opinion that this piece of commercial real estate should also be up by a like percentage. Turns out that was not the case. And so I guess what I want to point out here is when you're making that type of investment in rental real estate, I guess it's important to understand what the metrics are to value that kind of thing. So whereas in a residential kind of purchase, is a set of factors that people look at to determine the fair market value. Office space, restaurant space, things that have different uses, have a different way of measuring what the true value is. So this cap rate comes into play, and it's important to, I guess, know what an appraiser is going to look at on if before you get involved and make down payments and go out and try to obtain financing, because sometimes the initial price might be higher than the bank's going to lend you, and you just got out of luck. So so that's a lesson learned from some observations this week. So be careful. As always, know what you're talking about. Don't estimate. Don't get too overconfident in your ability. And then some planning things. So we got past that business deadline last week. However, coming forward, October 15th is sneaking up on us here, which is the deadline for any individuals who put their taxes on extension. So that's out there as a deadline, but also for planning for 2025 taxes. So there are a number of credits out there. This is way beyond the more basic level of tax planning. But I just wanted to point out that if you have a potential of a big gain in income for 2025 and you're trying to get some more advanced strategies, there's a couple out there that have a deadline coming up kind of quickly. So there's energy asset tax mitigation and solar tax credits, September 30th and then October 1st for this one. So essentially, the end of the month, those two are going to be unavailable. And those are some pretty good credits. So they, in both cases, they require some amount of cash, influx. So you're not, you have to pay out some money. However, both of these have very favorable tax, benefits in the first year, and as an investment component to at least one of them that kind of continues for subsequent years. So way more detail than we have time to really talk about today, but just know there are things out there that we got that they have some debt. So it's not December 31st. Some of these things that we look at on a regular basis do have deadlines that are coming up a little bit faster than normal. So reach out to us if you have any questions or planning concerns there, and we'll get you taken care of. So closing thoughts. So as we looked at things last week, I always, like I said, all my Stoic quotes, I look at them every day. So this is a company here called Via Stoica. Look at their posts on a daily basis. I'm trying to get their email and different observations. But actually, the second thing is the one that's jumping out at the most. So as we got another week behind us, a lot going on, a lot of individual cases to deal with as that deadline was on us. That focus on one action at a time jumped out at me, because you get the email influx, the text message influx, the messages coming left and right, and you got things on your desk. So the ability to step back, quiet all that stuff, and just do one thing at a time and get it done is good. Multitasking, I think, is bad from what I've experienced myself, and one thing at a time is my takeaway from that. And that's it. So we made it to another week. I'll look forward to seeing y'all out here next week.